Welcome back to the deep dive. This is where we take a whole stack of sources, could be articles, research, maybe even your notes, and well, we boil it all down to the most crucial insights just for you. Today, we're tackling something huge. Growing your wealth through the stock market. It feels complex, right? So we're cutting through that.
It definitely can seem that way.
Yeah, and our guide for this deep dive comes from Key Ideas in Growing Wealth, a guide to stock market investing. It's really focused on practical steps.
A solid foundation.
Exactly. Our mission here is simple. Extract the core wisdom so you can build wealth effectively, and maybe more importantly, dodge those common, costly mistakes. You know, the ones that trip people up.
Surprisingly common ones, too.
Right. Okay, let's unpack this. Let's get right into it.
Let's do it.
So the guide, it doesn't really pull any punches. It starts with a pretty stark point. Even though the market generally goes up long term, a lot of investors, well, they lose money or they just don't do nearly as well as they could.
It's true, and it's often not just about picking the wrong stock.
No, exactly. The source points to specific behaviors, things like buying stocks when they're super high, maybe because of FOMO, fear of missing out.
Chasing performance.
Or maybe picking companies without really digging in, doing that essential research. You know, separating informed investing from just guessing.
Speculation versus strategy. Big difference.
Huge. Then there's the classic one, panic selling when the market dips, locking in those losses.
Ouch. That hurts long term.
Definitely. And maybe the sneakiest one, just waiting too long to start, letting inertia win.
Procrastination is the thief of compound interest.
Huh. Well put. So our goal today really is to use the insights from this guide to help you recognize these traps and, crucially, avoid them.
Right. And what's fascinating here, picking up on that, is how these mistakes aren't just about, say, lacking financial knowledge. They're also rooted in our own psychology.
Emotional responses.
Exactly. The guide kind of hints at this. Buying high. That could be recency bias, thinking what just happened will keep happening. Picking without research. Maybe overconfidence.
Believing that hot tip is enough.
And panic selling. That's almost pure loss aversion. The fear of losing feels way stronger than the potential for gain, so people sell at the absolute worst time.
Just to make the pain stop.
Precisely. And waiting to start, that's often just procrastination, maybe mixed with a bit of, oh, I'll start when the market's better, kind of thinking.
Yeah, timing the market perfectly, which is tricky.
To say the least. So the guide really stresses that understanding these emotional pulls is step one. It's about building your mental defense before you even invest a dollar.
Okay, so knowing the pitfalls is critical. But it's easy to hear all that and think, wow, maybe this is just too hard.
It can sound daunting.
Yeah, but the guide quickly shifts gears and moves from the problems to this really powerful solution, something often overlooked. And here's where it gets really interesting. This fact from the source is, I think, potentially life-changing. It's the power of just starting early.
The time factor.
Exactly. The guide gives this amazing example. If you invest just $100 a month and you get a 10% average annual return, which, you know, is in line with long-term historical averages over 46 years, that can grow to $1 million.
Wow. From $100 a month.
Right. The source is blunt. Yes, the earlier you start, the better. It's not just nice advice. It really shows a core financial truth.
In that example, it's not just a nice number. It's compound interest made visible.
Explain that a bit more, the magic of compounding.
Well, it's more than just interest on interest. It's that exponential curve. Your money earns returns, and those returns start earning their own returns, and it just snowballs.
So it accelerates over time.
Massively. And the key thing informed investors get is that time itself becomes your biggest asset. That 46 years isn't random. It's how long it takes for that small, steady amount to really explode in value, assuming those historical returns.
And it directly counters that mistake of waiting too long.
Absolutely. Starting early maximizes the runway for compounding. If we connect this to the bigger picture, that one example, it basically sums up the whole philosophy the guide pushes. Long-term thinking, consistency, and just respecting the power of time.
Patience and discipline pay off, literally.
Exactly. It shows that even if you start small, consistent action early on can lead to really significant wealth down the road.
Okay, so we know the what avoid mistakes, start early. Now the how. How do we actually do it?
Right, the practical steps.
And the guide lays out a pretty clear framework. It boils down to 3 main steps. Number 1, learn. Number 2, invest. And number 3, automate.
Learn, invest, automate. Simple, but powerful.
Let's dig into that first one. Learn. The guide says a key starting point here is asking yourself, Do I want to be a passive investor or an active one? What does that choice really mean?
Yeah, this learn phase isn't about becoming a Wall Street guru overnight. It's more about self-discovery and understanding the options. The guide does a good job distinguishing passive versus active.
So what's the passive route look like, according to the guide?
Okay, passive investing is generally more hands-off. You're not trying to beat the market. You're aiming to match it. Think ETFs, exchange-traded funds, index funds, or mutual funds.
The kind of things many people are familiar with.
Right. But for someone who already knows the basics, the guide subtly pushes you to think deeper. Like, consider the expense ratios, the fees. They seem small, but they really add up over decades.
Eating into your returns silently.
Exactly. Or think about tax efficiency. Some funds generate more taxable events than others. Index funds are often quite tax efficient. ETFs offer flexibility, like trading during the day, and often have lower costs. Mutual funds might be simpler for automatic investing.
So it's about choosing the right passive vehicle for your situation.
Precisely. It's broad exposure, diversification, less daily stress. Good for people who want to focus their energy elsewhere.
Okay, that makes sense for the hands-off approach, but what about the other side, for people who actually want to be more involved?
That brings us to active investors. The guide defines these as the folks who want to pick individual stocks, build their own portfolio, piece by piece.
More control, potentially more reward.
Potentially, yes.
Yeah.
But the source is clear. This path requires a serious commitment, more research, more time, constant monitoring. The learning here isn't just knowing that you need research, it's knowing what kind.
Like digging into company financials.
Exactly. Fundamental analysis,
Yeah.
looking at income statements, balance sheets, cash flow, understanding things like PE ratios for valuation, debt levels, cash generation.
So really understanding the business itself.
Right. And the industry, the competition, the management quality. It's not just about ticker symbols and charts. It's about business analysis. The potential upside is higher returns, but so is the risk. Plus, more trading often means higher costs and taxes.
It's a significant trade-off then. Time and risk for potential reward.
Absolutely. So the key takeaway from the guide on this learn step is be honest with yourself. What's your personality? How much time do you really have? What's your actual tolerance for risk? Choose the path, passive or active, that truly fits you.
That self-assessment seems critical. Getting that wrong seems like setting yourself up for failure, doesn't
It's a
it?
huge potential pitfall, yes.
So whether you're going deep on individual companies or taking the broader market approach, the guide circles back with a universal piece of advice. This links to the third step, automate. It really hammers home automating your contributions. How does that work for both types of investors?
Yeah, automation is the great equalizer here. It works brilliantly regardless of strategy. The guide says, automate your contributions so you stay invested without thinking about it. That's powerful.
Why is this so crucial?
Because it tackles the biggest behavioral hurdle, consistency. For an active investor, maybe busy researching, automation ensures money keeps going in. For a passive investor, it makes the whole process effortless, almost invisible.
Takes the decision-making out of it each month or paycheck.
Exactly. It removes that friction. It fights procrastination, stops you from diverting the money elsewhere, just this once. And think about dollar cost averaging.
Buying regularly, regardless of price.
Right. By investing a fixed amount automatically, you buy more shares when prices are low, fewer when they're high. It smooths out your average cost over time, reduces the risk of dumping a large sum in at a market peak.
Ah, okay. So it's a risk management tool too.
Definitely. Automation keeps you disciplined through ups and downs, taking emotion out of the equation. It's like setting up guardrails for yourself. Which, this raises an important question for you, the listener. What systems can you implement to keep your strategy on track consistently?
That consistency piece, the automation, it leads right into the final core idea, thinking long-term. The guide is super clear. This is not a get-rich-quick scheme. It's a marathon.
An ultra-marathon.
Yeah. And it tackles that big fear. Market drops, it says. During drops in the stock market, like right now, acknowledging volatility is normal, the advice is. Don't panic, stay the course.
Easy to say, hard to do sometimes.
Very true. But the guide explains the why. Why is staying put so important?
Well, staying the course isn't just about being stubborn. It's strategic. It directly fights that loss aversion we talked about. Panic selling when things look bleak. You're just crystallizing your losses.
Turning taper losses into real ones.
Exactly. You sell low, potentially miss the recovery. History shows markets recover. It might take time, but they do. Staying invested means you're there for the rebound. Selling often means missing the best recovery days, which can have a huge impact on long-term returns.
So it's about resilience, understanding that dips are part of the journey.
Yes, they're normal, expected. Not a signal to abandon ship if your original reasons for investing are still sound.
But the guide doesn't just say do nothing during a downturn, does it?
No, and this is key. It offers a proactive move. Reinvest dividends to compound your wealth faster.
Using those dividend payouts.
Right. Dividends aren't just income. They're fuel for more growth. When you reinvest them, maybe automatically through a DRIP plan, you're buying more shares of that company or fund.
Okay.
Now, think about doing that during a market drop. Share prices are lower, so your reinvested dividends buy more shares than they would when prices were high.
Oh, interesting. So you're getting more bang for your dividend buck.
Precisely. You're effectively buying low, automatically accumulating more assets when they're cheaper. It turbocharges the compounding effect when the market eventually turns around. What's fascinating here is this transforms market drops from something scary into, well, an opportunity.
If you have the discipline.
If you have the discipline and long-term perspective, yes, it turns fear into a potential advantage for building wealth faster over the long haul.
That's a powerful reframing.
Okay.
So the overall message, loud and clear from the source, investing is a long game. Do not rush this
Well, I
process.
couldn't say it better.
So what does this all mean? What's the bottom line for you listening? It means patience, strategy, and discipline aren't just nice ideas. They are, quite literally, your best tools for building real lasting wealth.
Solid tools.
So let's recap quickly. We dove into Growing Wealth, a guide to stock market investing today. We identified those common traps, buying high, not researching, panic selling, starting late, and the psychology behind them.
Understanding the why is crucial.
Absolutely. Then we saw the incredible power of starting early, that potential million from just $100 a month. We walked through the core steps, learn choosing passive or active with your eyes open.
Understanding the nuances.
Right. Invest putting the plan into action, and automate making consistency almost effortless.
The behavioral safeguard.
And finally, the long game, staying the course during volatility and maybe even using those dips through reinvesting dividends to accelerate growth. This whole deep dive really was about giving you a practical shortcut to being well-informed using the wisdom from this guide.
It's solid, actionable advice. And maybe, to build on all that, here's a final thought for you to consider.
Okay.
We've talked about several principles. Knowing them is one thing, but doing them is where the magic happens. So, think about this. Which one specific strategy from today? Maybe it's setting up that first automatic transfer, however small. Maybe it's spending an hour truly comparing the costs of different ETFs you own or are considering. Or maybe it's just writing down your own stay-the-course plan for the next time the market gets shaky. Which one could you commit to implementing, starting now?
Just picking one thing to actually do.
Exactly. How could making that one change and sticking with it fundamentally shift your financial future over the next, say, 10 years? The path to significant wealth often doesn't start with some grand, complex maneuver. It really does begin with that single, informed, consistently applied step.